It's probably fair to say that builders of all kinds are having to deal with crises all their own. Now, while cash management is always of critical importance, and these days it's probably even more acutely important. So take a minute and we'll go through one of the things you can do today to help improve your cash position as we work our way through the current COVID-19 crisis. If you've attended one of our construction business basics programs in financial management, you might recognize this slide. We've been saying, and there's nothing new to shocks to the industry, although nobody could claim they could see this one coming. One of the other things that you might recognize from this slide is that you have to acknowledge that you have other stakeholders, and particularly at times like these, you have to be able to communicate with them in ways that are going to be meaningful and helpful to them. So we're going to look at your cash projections in this slideshow, hopefully so that you can have a better way of communicating with those people who could have a stake in your future. Probably the biggest change in your relationship with any lender under current circumstances is that everybody looks like a higher risk. While there's uncertainty out there, everybody looks like a higher risk. It could well be that you're going to be requesting more money to help you through the crisis, and in doing that, you must be prepared to demonstrate to potential lenders that you have control over that risk, that you can provide them the information that helps them assess that risk, because risk is the thing that they're most concerned about these days. Now, in order to address that, they'll be looking at things at two general levels. The first is, can they count on you as a borrower? Now, to a large extent, that's driven by their assessment of your ability to manage. Do you know what you're talking about, and are you capable of running a business through current crises? But when we come to a specific request for money, and probably through this what we're talking about for the most part is a line of credit, that you'll be looking for temporary financing to help you through a period while cash flow may dry up. And in order to help a lender assess that risk, there are three questions they'll be asking specifically to your request. When will you need it? If you need it tomorrow, that's not a very good thing. If you can tell them that you're going to need it several weeks out or several months out, that tells them more about how well you've got an eye on the future. How much are you likely to need? If you can't tell them how deep you're going to need to go into a line of credit, then you don't look like a very good risk to them. And of course, one of their other major concerns is when can you expect to pay them back? We're going to talk about a cash flow projection because that is the way to provide to lenders the answers to all of these questions. So let's go step by step through how you would prepare a cash flow projection for your business. If you do that, it's going to tell you a lot of useful information about what you have to be prepared for over the coming weeks. And it's more critically, it's going to tell potential lenders how well you see your needs in the coming weeks and how well you will be able to control that. So the first thing we want to do is set up a table. Now, in our example, we've set this up with one column per month for 12 months. You may not feel that you need to go out 12 months, but you should probably at least go 6 months because the cash implications of what happens today could cascade for a little while yet. That's not to say we'll be in crisis for that time, but you need to be prepared for the possibility that the cash impact will be with you for a little while. So we set it up one column per month, in our case for 12 months. Then we set up a section for cash inflows. Now, throughout all of this, you need to be clear. We're talking about when cash actually comes into your bank account. Just because you wrote an invoice doesn't mean the cash is available to you. So whenever we count something, it's going to be money coming into the bank or going out of the bank. We set up a section for cash coming in, and we set up another section for cash going out. And then we have a lower section below in which some arithmetic will be carried out, and we'll explain that as we progress. The next thing that you would do is you have to assess, and our recommendation is that you look at each project and you assess what the outlook is for that. You may have some projects that are put in on hold, as in our example, we've looked at project one. We say that's going to proceed, but it's on hold for now, and we've agreed with the client that we're going to wait until we see what happens. The second one, project two, we've just acknowledged it's canceled. Now, we have to face the fact that some clients will simply get cold feet and they'll pull back and that project won't be resurrected. Project three, we're saying that's proceeding as planned. We still have work going on and we're going to carry on. And project four is a project that will continue, but it's being delayed. Perhaps we've agreed with the client that we'll wait until things settle down a little bit and we'll pick it up later. Now, if we go down into the cost section, we set up a separate line for each one of those projects as well. From this point, we start to look at the detailed monthly financial activity for each project. And this is the point at which this exercise requires your involvement. You can't delegate this. You're the one who knows the terms of payment that are built into your contract. You're the one that knows realistically when you can expect payment to be received. And when it comes to executing work in the field, you're also the one that's going to know best the rate at which you're going to spend money. So project by project, month by month, we're going to look at, first of all, when do we expect money to come in? And in our example, project 1, while we've acknowledged that it's going to be on hold, the customer has agreed to pay us a $10,000 deposit in order to keep that on the build schedule. Then when we go down to the cost section, we also have to recognize that there will be some costs against projects, even though there may not be any activity expected in the future. In our example, project 1 and project 2, the one that got canceled, we're acknowledging that in fact we've already invested some expenses in that. We're going to see some charges maybe from a designer or for pre-ordering materials or something like that, but we're acknowledging that those are costs. And once again, remember, this is money actually going through the bank account. Then when we look at project 3, that's a project that's going to be ongoing. The payments that we receive are probably derived from the contract. You should have progress payments articulated in your contract. And in this example, we've got monthly invoicing, which will be paid out at the rate of $20,000 a month and for the life of the project. And then we also recognize there will be a holdback, and probably typically that's going to be 60 days from the time we hand over the project before the holdback is released. Similarly, when we go down to the cost section, and this is where you have to be very objective and use your best assessment of when you will spend money to carry out the project. We're looking at this and we're saying we're going to start spending money on the first month of activity at the rate of $20,000, ramping up to $30,000, and ultimately we wind up the project in month 5, having spent a total of $100,000. Then when we come to project 4, we do the same exercise. When do we expect payment? That, again, that's probably denominated in the contract. We have progress payments, and in our example, those progress payments for this project are larger payments that come a little further apart. And once again, we expect the holdback to be paid sometime after the project is complete. And then when we come down to the expense section, we're acknowledging the rate at which we intend to spend money to carry out the work, starting at a very modest pace of $5,000 in month 3, and then ramping up as we go forward. One thing that you should also make provision for is how much money do you have in the bank today? In our case, we show a starting balance of $50,000. Remember, we're counting cash. This is not about the profitability of those projects. We're just looking to make sure that there's cash in the bank. So we have a starting balance of $50,000, which leaves us something to work with. The other thing not to overlook, and it's critical, is to recognize that you will have ongoing overhead costs. You have to be prepared for those, and you have to plug them in. If you take a cash flow projection to a lender and you fail to acknowledge that you've got ongoing overhead expenses, that's not going to look very realistic. You haven't helped them assess your risk. And when we talk about overheads, we're talking about things that don't go away just because you're not doing work or because you're operating at a slower pace. You will probably still have rent, you will still have vehicle leases, you may still have an administrative employee that you're having come in. You're going to have to pay those expenses. Now that we've drawn on your insight as the general manager of the business and we've filled in the details specific to when money will be coming into the business or when it will be going out, we can now depend on some basic arithmetic. So the first thing we do is we add up each column in the cash inflow section. So we can see in month 1, we received that deposit payment of $10,000. In month 2, we received 2 progress payments for the projects that are ongoing for a total of $35,000. And on we go. So month by month, we get a total of cash that has come into the business. Then we go down to the expense section, and once again, we simply total the columns month by month. Now we can see that in month 1, we incurred those expenses for those projects that aren't ongoing, and critically, we've recognized that we have some overhead expenses. So once again, month by month, we get a sum for the expenses that were incurred in each of those projects. So we know for each month how much money came into the business, and we know how much money left our bank account in order to pay expenses. What we need to do now is see what the net effect of that is for each month. So if we look at month one, we received that $10,000 deposit payment, and we also recognize that we incurred some expenses even though those projects were not ongoing, and we recognize that we had overhead expenses. So we have total money leaving our bank account of $28,000, and we received $10,000 in payments. So that means $18,000 came out of our bank account in excess of what we received. And then if we go to month two, we can see that we saw some progress payments for a total of $35,000. Once again, we saw expenditures of $28,000, but in this case, because we received a little bit more money than we spent, we have a positive number of $7,000. And so it goes from one month to the next. And you can see if you do it this way that this scenario is probably far too complex for anyone to actually be able to anticipate or go on instinct or figure it out in their head. You really have to lay it out and see what the numbers tell you. Now, to be truly informative, we have to use our analysis to be able to look into the future and see what our bank balance might be several weeks or months into the future. So for that, we prepare what's called a running cash balance. And to do that, we look at our beginning balance and we make adjustments month by month for what happened in the month in question. So in our example, we started with $50,000 as our starting cash balance. And then when we look at month one, we see that we brought in $10,000 as a deposit, but we spent $28,000 in conducting operations. So in month one, we actually had negative cash flow of $18,000. So if we subtract that $18,000 from the $50,000 starting point, that leaves us with $32,000. And now if we look ahead to the next month, we'll see that in month two, we actually had a positive cash balance. We brought in $35,000 of invoicing, and we spent $28,000 once again. So 35 minus 28, we have $7,000 positive. So that $7,000 added to the $32,000 that we had as a starting balance leaves us with $39,000 in the bank this month. And when we go to month three, as we look further out, we see what happens month to month, because in month three, we've actually gone negative by a substantial amount. But because we still had a balance in the bank enough to cover that, we still have our head above water, and so we don't yet have to tap into a line of credit. So in preparing our cash flow projection, we've answered three of those questions that are so crucial to a lender making a decision on whether they would wish to extend us a line of credit. The first is, when do we first need money? And we see from our analysis that we'll be looking for some money in month 5. The next question they need to know is, how much will we ultimately need to have? How deep into a line of credit would we need to go? And we can answer that question by looking out to month 8. We'll see that we need to borrow as much as $44,000. And of course, the third question that they want to know is, when can we expect to pay them back? Now, one of the things that you have to realize in this is that you have to do this in advance. If you show up at the end of a month and saying, I need money by next week, that doesn't look like a very good risk for a lender. You need to project out into the future, and hopefully you see in this analysis that the impact on your cash flow sometimes doesn't show up when you might expect it. So you have to let the numbers tell the story. Now let's recap the steps in order to prepare a formal cash flow projection. Before we get started on that though, recognize that this is actually a fairly simple spreadsheet, and if you have any facility with Excel or you know somebody who can help you with Excel, you should set this up as an Excel spreadsheet. It'll help you do some of the arithmetic and make it a little easier for you to work with. But to set it up, you start with setting up one column per month. Now we recommend you do at least 6 months, probably 12 months is better, because things that happen today can have an impact on your cash flow well into the future, and you won't recognize that if you don't run out your analysis far enough. So use at least 6 months, probably 12 months. Set up a section for cash receipts. This is money coming in. Set it up with one row per project, because you'll have better judgments on when money comes in if you're looking at each individual project and you know whether or not you're expecting money to come from that. Once again, you set up a cash expenditure section with one row per project. You enter when you expect cash to come into you, not when you issue an invoice. We're measuring money in your bank account, so you need to measure when the cash is actually going to be paid to you. You do the same for your expenditures month by month, what you expect in order to carry out the work that you're going to do. Remember, in your expenditures, you have to allow for overhead costs. They will consume your cash as well. Then you total each column, both for the amount of money coming in and the amount of money going out. So we have a series of totals month by month of money that came in and money that went out. Now you enter your starting balance. How much money did you have before going forward from today? What's in your bank account today? So what we need now is to recognize what happens in each month in terms of whether we were positive or negative. If we received more money than we spent in any given month, we're positive for that month. If we spent more money than we brought in, we will be negative for that month. But in order for this to become informative, we have to do a running cash balance. This is what's going to tell us what our bank account is going to look like any time out into the future. We do that by taking our starting balance and then adjusting for the events in any given month. And as we go forward, we will see what our bank balance will look like based on activities in any given month. So what we have from our formal cash flow projection is an assessment of what our cash requirements might be as we go out into the future. And this is valuable to you because it helps you make plans as well. It takes away some of your uncertainty. It helps you arrange for activities according to whether or not you can afford it month by month. It also helps you speak knowledgeably to customers, suppliers, sub-trades. Some of your subs will be very reassured if you can tell them that you know what's going to happen and that you expect to have money available to pay the bills as you go forward. Now, one thing that potentially adds a little confusion but needs to be addressed here is that HST does not enter into this analysis in any way. You should be careful that you don't blend HST money with your operating cash. It can be very tempting if you've charged a customer and included HST and that cash has come to you. It's very easy to spend that cash, but it's not yours. You need to be disciplined and make sure you set that aside because it really is not available. And if you do something like that, then one day you're going to get an HST bill and it's really going to catch you flat-footed. So be careful that you do not blend HST receipts, money that you've collected from customers for HST, do not blend it with your operating cash. Now, as useful as a cash flow projection is to us to make proper decisions for running our business, of course, we're also doing this so that we can give a proper picture of our business to a potential lender. And if we do it properly, we have been able to give them information that helps them answer those three critical questions as they're assessing risk for any borrower. You can tell them when you will need cash. You can tell them how much you will ultimately need. How far is bottom for you? And then you can tell them when you can expect to pay them back. And in doing that, you've also helped them assess one other level of risk, and that's your general management capability. If you've shown the capacity to look into the future and anticipate what's coming, they have a much better feeling that you know what you're doing, that you'll be able to manage your way through the coming challenges. So do a proper cash flow projection. Do it in time so that you can go to a potential lender and tell them at some time in the future, I will need money. Can we negotiate a line of credit? Because if you don't do that beforehand and you show up and you're looking for money tomorrow because you've run into a cash problem today, that's telling them the one thing they don't want to hear, and that is that you are a risky borrower. Best of luck to you as you navigate through these challenging times. To learn more about how to prepare a cash flow projection for your business, or if you'd just like to discuss potential challenges to your business through these times, contact us at MMI Professional Services at info@mmiproservices.com or phone 647-998-7722.